Welcome to Capital Conversations, where innovation meets opportunity. Join hosts Rands and Erik Nelson as they unpack the realities of raising capital, from angel investing to IPOs, and reveal what it takes for companies and investors to thrive in today's changing markets. Let's get started.
Hello, welcome back to Capital Conversations. Of course, I'm Rands, and today we have Erik here as my co-host, and we have a special guest, Richard Krieger, that is comes from a deep experience in the capital markets. We are really excited. We've been talking about this series and that we did an intro for the IPOs, going public, the purpose of public and private capital markets, hot news last week. Erik's going to come back on that a little bit. And Erik and Richard go back way far, so you're going to hear a lot more about his intro, but I just want to share with you the highlights and some of the things that I think are really interesting with all of his experience as an investment banker and in the financial space. Richard bought Moody Capital, which is a local investment banking house and broker dealer here in Atlanta that has deep roots in the community, and now is taking that to a whole new level of new heights. You're going to hear about some today. And he bought that last year. And so we're excited to have him as part of our show today. We're going to jump in. We've got a bunch of questions to ask him, put him in the hot seat. And let me give the disclaimer first, because the information provided in this podcast is for educational and informational purposes only and is not intended as financial advice. The views and opinions expressed by the hosts and guests are their own and do not necessarily reflect the official policy or position of any financial institution or organization. You should always consult with a qualified financial advisor or conduct your own research before making any investment decisions. The content of this podcast may include forward-looking statements that are subject to risks and uncertainties. We do not guarantee the accuracy, completeness, or usefulness of any information discussed. By listening to this podcast, you agree not to hold the host, guests, or any affiliated parties liable for any losses or damages that may arise from your reliance on the information provided. And with that, take it away, Erik.
Hey, good morning. This is Erik Nelson, and it's March 18th. We're on our fourth podcast, and I'm very pleased to have as our special guest today Richard Krieger, who I've known for, I think, about 6 years now, and seen him at a variety of the different conferences I've been at. Rich has got a pretty nice investment banking career. He's focused on some interesting areas that I think are going to be useful and insightful. And as Rich has recently closed the acquisition of Moody Capital, I think it's going to be very beneficial for all of us to hear about his upcoming plans and how he plans on growing and expanding the firm. Before we get started on the interview, I'd like to take a moment to look back at something I said on last week's episode about the Dow Jones Industrial Average. On January 30th of this year, the Dow Jones Industrial Average closed at a new all-time high of 44,882. Then, for a variety of reasons, it had proceeded to decline up and through the point of our podcast on March 11th. It basically put in a short-term bottom around March 13th, or on March 13th, when it closed at 40,813, a decline of over 4,070 points. When I was on that podcast, I said I'd take a look at the charts and see where I saw support. Well, I went back and took a closer look at the chart of the Dow Jones Industrial Average, and last August 7th, the Dow Jones Industrial Average closed at 38,763 points. The next day, it gapped higher on the open and had an intraday low of 38,922 points, about a 160 point difference right there. And that created a gap on the charts. And one of the best known rules of thumb, if you're a market technician, and I've been studying charts since the early 90s, so I've got over 32 years of experience looking at charts, is, and this is a really good rule of thumb, the markets hate gaps on the charts. And in particular on a major index, the market will always do a retracement at some point to fill that gap in on the chart, and it's better to do it sooner rather than later. So what I see is I really see support coming into play and providing downside support from which a rally might be able to start at around this 38,763 level. So I'm going to go on record saying that, and we will see how I do over the course of the next couple of weeks. But with that having been said, I'd like to introduce everyone to Richard Krieger. As I've said, I've known him for 6 years. I met him in January of 2019 at the National Investment Bankers Association conference up in New York City when I was representing a company called Nocera that ultimately uplisted to the NASDAQ. So, Rich, why don't you go ahead and introduce yourself and tell us a little bit more about yourself and your career?
Sure. So my name is Richard Krieger. I'm currently the CEO of Moody Capital Solutions as of about a week ago. We acquired Moody Capital Solutions through the holding company Growth Fountain Holdings. And as a result, I'm now the controlling shareholder of Moody. We have about 10 investment bankers today, up from 4 a year ago. Our focus is on private placements, pre-IPO companies, as well as raising money for publicly traded companies. Mostly micro-cap and small-cap issuers. We've spent most of our time thinking about how we can create the new flywheel effect for investment banking, how we can have a frictionless operation. And so far, we've been able to grow using technology, implementing more and more scale to that technology, a lot of travel, and no offices. So you tend to see us traveling around from city to city. I think we've been in 20 cities in the last 7 weeks, everywhere from California to Florida to Kansas City, New Jersey. And we have been very active meeting with publicly traded companies and investors, have a really good pulse of what's going on around the country. And for the last 30 years, I've been in the finance business. Started off in the truck leasing industry, went into the beverage business, and then got recruited to start my own hedge fund. That was called Crisis Managed Value Fund. The idea was to look for crisis valuations where companies were perceived to be in a crisis but weren't an actual crisis. It's a very deep value strategy. And I was recruited into investment banking in 2004 to work for a firm called H.C. Wainwright. At H.C. Wainwright, we were the third most active broker-dealer in the country doing private placements. Was recruited from there to start a firm called Midtown Partners, where I was for 4 years. I think we were a top 5 investment bank in the country doing private placements. And then the crisis of 2008, 2009 hit, joined Maxim Group, and then watched the Dow Jones collapse to much lower than you just mentioned, Eric.
Yeah.
As we fell into a banking crisis. That banking crisis was pretty bad. We had firms like Countrywide Credit go out of business, Washington Mutual, Lehman Brothers filed for bankruptcy. And at that point in time, the question was Bear Stearns going to survive or not? And as you can remember, I think Bear Stearns was offered $2 a share by JP Morgan to be purchased. And I think eventually it was purchased for $6 a share.
Yeah, they had to raise it upwards. The building itself was worth $2 a share at One Metrotech.
Yeah. So, fast forward to where we are today. We're in a very different market. We've been through several rounds of TARP funding and pandemics. And to be here operating as an investment banker 20 years later, it's important to pivot given different circumstances. So in 2009, when Lehman Brothers collapsed and no publicly traded company could raise capital, I decided to do my research and learn about rights offerings. Yep. And what I realized at that time was that the most likely person to invest in a publicly traded company during a crisis are the existing shareholders. So we developed a strategy to both target new buyers who would be attracted to buy the stock in the open market and become potential investors. And we focused on the existing shareholders as well. How can we give the shareholders a reward for staying loyal and buying the stock at potentially a lower stock price than they typically could? And fast forward 20 years of my career, we've completed almost 40 rights offerings and about 300 private placements. That's me in a bottle.
Yeah, and we've talked in the past. I'm a big fan of the rights offerings. I own a transfer agency. I think they're great business for the transfer agency. I think that one of the things when I saw your video as you were on your way to the airport going to Kansas City, and you talked about treating your shareholders as customers, and this is something I've always advocated. I'm 36 years in the securities industry one way or another since I graduated college. And throughout that time, I have urged more companies than I can imagine to communicate to their existing shareholders. And that is one of the hardest things to get them to do. But when they realize that those existing shareholders can help them raise money either through a private placement or a rights offering, it becomes really a different ballgame. And I'd like to get your thoughts on what you think public company executives should be doing as far as shareholder communication to prepare for, a rights offering or keep that as an arrow in their quiver.
Yeah, well, I think what's important is both private and publicly traded companies have existing shareholders. And in the private markets, you see venture capital firms quintessentially asking for preemptive rights to invest in follow-on rounds. Those are typically referred to as right of participations or right of first refusals. Certain states like Georgia, I think, still have preemptive rights. So if you become a Georgia corporation and you want to raise capital, you have to offer to the existing shareholders the right to participate in your financings. I think there's less than 10 states that actually have that beneficial owner protection. State of Delaware was one of the first states to eliminate the beneficial ownership regulation so that you could actually form a corporation in Delaware and not be required to offer that financing to existing shareholders. Some corporations, when you form in the state, actually have a check the box option. Do you want to be obligated to offer it to existing shareholders or not? And most attorneys will recommend that you not check the box where you're obligated to offer it to existing shareholders. So in Europe, many countries, you're obligated to offer it to existing shareholders before new ones, in Australia as well. And there's many different carve-outs to be able to do that. What's interesting is that I very much do view, like you said, Eric, I very much do view clients as being your customers. I very much view investors as being your customers. And in fact, many publicly traded companies that are, for example, Microsoft, has many investors who both use Microsoft software as well as are shareholders. You have people that use Apple iPhones and are also shareholders, people who own Tesla cars and are shareholders. So in the consumer products business, you see a lot of crossover where people buy stocks in companies they believe in. When you have a more eclectic company, like a company that makes semiconductors or business to business, I find that you have generally less trading liquidity and less widespread ownership, such as industrials, because regular retail folks don't typically understand those businesses. But the people who do own the stock typically are very educated on those businesses. And what's interesting is these are people who typically have done a tremendous amount of research, institutions especially, financial advisors especially, and they dig into the financials and they put their own clients in the stock. If you're a fund manager, you're putting your investors in indirectly. But if you're an RIA, a registered investment advisor, you're typically putting investors in on an individual basis. So one thing we've learned over time is treat your customers well, right? You treat your customers well, and hopefully you'll attract new customers. But when a lot of companies go out to raise capital, as an example, they focus on raising money quickly. There's a very common transaction that's called an overnight offering, where basically you go out really quickly, you offer it overnight, new institutions come in, and you close your financing. And typically the stock trades down significantly. Now,
Yes.
those loyal registered investment advisors and money managers that own your stock are typically blindsided, and they're upset. Like, why didn't we get the chance to participate in this transaction? And so I can go into sort of the method of why we do things the way that we do. But essentially, the only way you can target every investor that owns your stock is through a rights offering. There's really no other way. And the reason for that is because when you do a rights offering, all of the securities are distributed through a dividend to the shareholders, similar to when you get a cash coupon when you own stock. And let's say IBM, they send you a monthly or quarterly cash dividend. Every broker-dealer distributes that dividend to you. Rights offerings are distributed the same way through the reorg process, and it involves using firms like yours, Eric, that are transfer agents to help make sure that every single shareholder receives those rights to participate.
And that's a positive thing. It gives in conversations with other friends that have owned transfer agents and what we've seen, we see a pretty consistent number of investors that will take advantage of this, and it's generally good for a minimal level of capital to make it worth your while to do a rights offering. And it's a very simple process of notifying the shareholders and making sure that depository trust has the appropriate information to get it to those shareholders that hold their shares in street name. Typically, a rights offering gives the investors a set number of days to exercise their right and subscribe to the shares and forward payment. And then afterwards, the rights kind of expire. I do know that larger companies, when they do rights offering, a lot of times those rights will be publicly traded. So an investor who does not want to participate can sell those rights to other investors who would like to. Have you had some experience with those, getting those up and getting those trading?
Yeah. I would say that the most active issuer of rights in the country has been the Gabelli funds. If you just look at Mario Gabelli and how he typically raises capital, he typically does tradable rights for his closed-end funds. And it's been a stalwart strategy for him that he's done. And he's just one of those deep value guys that believes in taking care of his shareholders and his investors. He's also a deep value investor and tends to invest in companies that do rights offerings. When we did a transaction for Ampco Pittsburgh a few years ago, Gabelli funds and the assets of which he manages, he also has a lot of RIA money as well. Gabelli was one of the largest investors into our Ampco Pittsburgh rights offering, which was about $19.3 million. So one of the things that's kind of interesting is that company was an industrial, so it wasn't a company that typically people understand. But what's also interesting is we have this big world of biotechnology. And what I find is, like customers and clients, a lot of biotech investors tend to be doctors and scientists and even patients or families of patients who are afflicted with diseases. So, for example, Alzheimer's. There's millions of people in this country that have a loved one that had or has Alzheimer's disease.
Yeah.
There are a few companies that have some approved products that have side effects, but you have a lot of drugs in the clinic as well. And those people, especially the doctors and the PhDs, tend to dig in and really understand science. And they don't get a chance to participate in a financing for the company.
Yeah. I mean, go ahead, Karen.
Yeah, so I'm, the part of what Eric and I, as we team up in this, he brings all of this knowledge and like your knowledge about the public markets and things like that compared to mine, which is more private on the private side. So, it sounds like from your conversation that this is not something that public companies routinely do. Is that true? And if so, then why is that?
Well, Eric, what do you think? What do you think the reason is that people aren't pursuing this as a common strategy?
I think there's a lot of uncertainty with public company CEOs in the small cap space and the micro cap space. And I think the reason they're uncertain is because they don't see a lot of other companies that have done that. I mean, Rich is, in my opinion, the foremost expert in rights offerings in this space. He talks about it more than anybody else I know, and he's done it more than anybody else I know. And when I've had conversations with the really good CFOs of some of my transfer agency clients, people like Scott Prail, they tend to favor the certainty of the overnight transaction because they just have not had the ability of attracting the larger, stable, longer term investors, the institutional investors they would like. And they generally are late to the table in doing their financings. They're not planning well ahead. And so they have an urgency to get it done and get it done quick with some sort of a guarantee, even if it's detrimental to their existing shareholders. And they will say something like, well, what choice do I really have? But that's another interesting topic. I mean, there's a right way to do this, and then there's a wrong way to do this. So one of the things I'd definitely like to have Rich talk about is what should you do and what should you not to do? And more importantly, let's start off with what not to do, so we segue into how to do it correctly.
Okay, so I'm going to answer both Karen's question and yours, Erik. So what Karen had asked was, why aren't more companies doing them? So to start there, what I would say is that traditionally rights offerings are done at a significant discount to market. And it used to be thought of that if you're a distressed company, that those are the companies that do rights offerings. That was debunked when Anheuser-Busch merged with InBev. When Anheuser-Busch merged with InBev, the Busch family wanted to reinvest in the company, and they only wanted to sell 20% of the business. So interestingly, they could have done a rights offering for 20% of the market cap at market, but they thought that not everyone would participate if they did it at market. So instead, they raised money at an 80% discount to market. 80% discount. And 100% of the investors came in and participated.
Okay.
So the bigger the discount in the rights offering, the less dilutive to the shareholders, which is fascinating because in any other financing, like a registered direct or a follow-on, the deeper the discount, the more dilutive to the existing shareholders.
Whoa, that's a major point right there.
And then Rio Tinto went on and did a massive rights offering. And we saw during TARP in the US, when we were doing rights offerings, most of the big investment banks and broker-dealers and banks in Europe did rights offerings instead of TARP. To your question, Erik, about what do people do wrong? What do people do right? Let me start off with what people do wrong. People think that you have to do a rights offering at a discount. They think that because they've historically raised money at a discount, they should continue to raise money at a discount. We've debunked that with our Ampco Pittsburgh transaction and the most recent two transactions that we've done. With Ampco Pittsburgh, when the stock was $1.80, we announced our rights offering. It traded up to $2.50, and we announced a unit offering of a common share with a warrant at $3.50, $1 above market. And the transaction was subscribed to $19.3 million, targeting up to $20 million. With Flex Shopper, which we announced recently, and Cytosorbents, when we announced our Cytosorbents transaction of a rights offering, the stock was 93 cents. We announced the deal at $1 with rights to subscribe at $1 or $2 or higher, which you can see in the press release.
Yep.
And that first transaction, the stock was at 91 cents when we closed our rights offering at $1, and we had 10.4 million in interest on a $6.25 million deal. So we ended up actually returning over $4 million to the shareholders. On Flex Shopper, when we did that first closing, that was at $1.70. When we announced it, we announced the pricing, this stock was $1.69, so we only priced it a penny above market. But we raised about $12 million in that transaction. When we first announced the transaction for Flex Shopper, their market cap was about $20 million. So we raised about 60% of the market cap. The stock, after we announced the pricing, traded up to $2.20. And if you look at, so it went from $1.70 to $2.20. If you look at Cytosorbents, the stock went from 91 cents to, I believe, $1.12. So what this tells us is that people who believe in the business and who believe in the fundamentals are willing to buy more stock in the companies and incubate them if they know that the company is getting the money and the company can be put to work to benefit the shareholders. We also find that not everyone participates when you do it above market. I would say on average about 10 to 15% of the shareholders actually come in if you do an above market transaction, but they tend to be the larger investors that understand the business and want to see it thrive.
That makes a lot of sense because they're the guys that are willing to buy it at a higher price. And they're going to be your longer term, more stable shareholders, which is a positive thing. Because
the negative is it takes 4 weeks, right? When you do a typical overnight deal, you basically, at 4 o'clock when the market closes, you launch your transaction, and in the morning you announce it. And so there's no embarrassment to the CEO or CFO because you can announce a closed offering. Nobody likes to launch an offering and not close it, right?
Yeah.
There's a stigma out there that you're a management team that's failed. With a rights offering, the biggest risk is that this offering's out there for a month. And will you or will you not raise the capital? And all the big clearing firms will hold back those orders until the final day where they release them to us. And they won't give us the transparency as to what they have in their accounts. The only way that we know who has orders is to speak to the institutional investors and RIAs and get a good sense from them of how much participation we have. And then we basically extrapolate the statistics, similar to how you poll for an election.
Okay,
so does a company typically speak to those institutional investors, or is that a function that your team brings to the table?
On our last 2 rights offerings, cytosorbents, which was oversubscribed, we didn't set up a single call for management. We handled everyone on our own. There were a few institutions that were long-term loyal shareholders that came in with some size. And in FlexShopper, we also spoke to all the institutions on our own. We didn't set up a roadshow. We didn't do a physical roadshow. And this is something we learned during COVID-19. During COVID-19, when we closed Amco Pittsburgh, people were saying you needed to do a physical roadshow or you couldn't close a transaction. But given the advent of Microsoft Teams, Zoom, digital access to technology, people are using software and even apps like Seeking Alpha for their data, and people consume their information digitally. In addition, the institutions we used to visit in New York City used to be the absolute hotbed of the financial world. I would say the hotbed of the financial world is now virtual. You cannot hit all the places that people are. So we've got major investors now that have moved to Las Vegas, to Miami, to Texas, to Vermont, and they are just basically willing and able to work from home.
Yeah, when we did the secondary on Nocera, I don't think the CEO did one physical roadshow, and he was able to get that deal closed. So you mentioned that your team had spoken to the registered investment advisors, other institutional investors, and had not needed to set up any management call. Clearly, it seems to me that having a investment bank with experience in this is key as well.
Yes. One of the big benefits is that when you do a rights offering, it's a public announcement, right? Yep. So you've announced the transaction, it's out there, there's a prospectus on file. People can rely on that prospectus as well as all the other filings that are incorporated into that prospectus, because most of these prospectuses incorporate by reference. And so when you're going out to these existing shareholders and new buyers who bought the stock in the open market, we don't have to explain to them what a cytosorbents are, right? They already know a lot about the company. They've been on their earnings calls, they've been on the webcasts. So it's a very soft call. It's not a cold call. And what we find is that these investors have been left out of every transaction, right? There have been multiple transactions that these companies have done, such as ATM equity offerings, where they don't even know if they buy the stock in the open market, if the company's getting any of the capital. So one of the most meaningful things about this transaction is the investors really appreciate that they know that every dollar they're investing in the rights offering is going to the company to fund it.
Yeah, that's an important key. I mean, I've seen what happens with some of these ATMs when they're ran wide open, and the company or their investment bank, hits the bid as hard and fast as they can. You see very significant decline in the market price of those securities, or as we saw with one regulatory action. A company CEO got in trouble for inappropriate promotions while they were doing an at-the-market offering. And so I believe ATMs have a place, but I don't believe that they should be giving kids the key to the candy store.
Yeah, I mean, the biggest problem when you speak to institutions that own stock in companies that have ATMs is they have a lot of uncertainty as to how many shares will ultimately be outstanding, right? Because the way an ATM works is the pricing of each takedown is based on where the stock is trading at the time of the takedown. The other problem is the institution doesn't know on what days the ATM is being tapped or not being tapped because the company doesn't make an announcement. The company doesn't announce, okay, today we're tapping our ATM, come and buy the stock in the open market, and we are going to fill your orders with stock from our ATM. So you have uncertainty about when you're drawing, uncertainty about number of shares that are taken down, uncertainty about ultimately how many shares will be outstanding. I don't think I've ever seen a floor price in ATMs. So the price can be lower and lower and lower. But for an investment bank, it's a very simple process. You essentially file a prospectus with the SEC, usually off of a shelf. It's usually you can usually tap it upon filing, and then you set up a brokerage account in which the company can deposit shares, and then you choose what days you want to sell those shares into the market, and the investor that's buying those shares through the ATM doesn't have any transparency as to whether they bought shares off the ATM or not. Well, it's completely opaque.
I believe in some days they basically can just offer the stock out or hit the bid constantly. I can tell you from personal experience, I'm not going to name names for obvious reasons, but I've walked in every morning and found an issuance request for over a month or two straight from some biotech companies that are raising capital through an ATM because they kind of feel that's the only option they got to stay in business. And that they're out if they don't. But, that it'll be some form of an issuance every single day.
I mean, the times when an ATM is beneficial is, let's say you have a biotech company that has an approval, right? They have a phase 3 with the SEC, with the FDA. The phase 3 goes through. They hear that they've got a new drug approval, which is fantastic. That's like the most exciting thing for a lot of these biotech companies. The stock goes up significantly. Maybe it's up a couple 100%. They have an ATM on file, and they can quietly tap that ATM that day and very efficiently raise capital. The problem is that those events are very few and far between. And most companies that are out of capital will use something like an ATM to tap even when their stocks are down. So then it becomes a very inefficient way to raise capital. And the person that typically makes the most money on the ATMs are the market makers, because the market, in order to buy or sell off an ATM, the ATM shares trade through a market maker. And the way the market maker makes money is they make the delta, which is the difference between where they sell stock off the ATM and where they buy it. And market makers are allowed to short your stock without a locate, which means that a market maker, if they see a regular inflow of new shares, can short your stock and then cover with the shares that are issued off the ATM.
And they can almost always short the stock enough to make it go down that day, if they want.
Correct. And that's correct. So ATMs tend to attract a lot of short selling.
Yeah, they do.
Whereas, if I can compare that to a rights offering, there's probably nothing more scary for a short seller than being short a stock that's doing a rights offering.
Particularly if they issue a warrant that they can't cover.
Or a right that gives you the right to buy more shares and more rights. Yeah. Because you can't ultimately calculate how many shares you're going to end up being short. So most short sellers, their goal is to short and then make money when the stock goes down and cover their short. So if someone shorts 1 million shares and the stock goes down and they cover their short on 1 million shares, that difference is their profit, similar to a market maker. But when you have a rights offering, let's say, for example, we do a rights offering at a 9-cent premium to market. And in the example of cytosorbents, we do a rights offering at $1, and you're short that stock. Now you have to figure out, wait a second, how many shares am I going to end up being short, right? I'm short 1 million, but if this transaction is fully subscribed, I could be short 2 million.
Yeah.
So I'm looking to make my short on 1 million, so I would cover my short on at least 500,000. So I could be sure I'm only short 1 million. But what if I'm short the stock because I think the company's going to go out of business. Well, now I have an even bigger problem because it's a rights offering. We know the company's raising capital, right? That pushes out the chance of bankruptcy. So now I've got two reasons to cover. Number one, I could end up short more stock than I intended. Number two, the company's going to have more cash than I anticipated. So then as a short seller, you basically say to yourself, wait a second, there's just better stocks to short than a company doing a rights offering. What also can blindside short sellers in a rights offering is often there's an oversubscription option. So let's say you're short 1,000 shares, but the person whose shares you're short oversubscribes for 1,000,000 shares, right? You could end up in a situation where you're short 100 times as many shares as you anticipated shorting. So again, you likely cover your short. Now, the problem is a lot of short sellers are not that sophisticated, and they may not even realize what's happening until it's too late.
Yeah.
And so we've seen a lot of funds blow up when they short companies into a rights offering.
Well, and that brings up an interesting thing about back at the market offerings. Melvin Capital was, I believe, short AMC Entertainment, the movie theater chain. And AMC Entertainment had an effective shelf offering. I believe it was technically an S3 filing, allowing them to do an at-the-market transaction. So when their stock ran, I believe cumulatively they raised over $1 billion, if my memory is correct, somewhere around 900 some million. So all of a sudden they went from being a cash strap to a cash rich company. And as of last I looked, Melvin Capital is actually out of business now. It was the end of their fund because of two short positions. You
know what's interesting, Eric? If you look at overstock.com, so back in 2016, actually back in 2015, we sat down with Patrick Byrne and Jonathan Johnson. Patrick Byrne was the CEO of overstock.com at the time. And they had developed a technology called T0 under their Medici subsidiary. Basically, it was developing a new form of blockchain using the original Bitcoin protocol, right? So you can call this, I guess, a side chain. So they were developing a platform to be able to trade a blockchain security at high speed. And by the way, at this point in time, in 2016, there had never been a public issuance of a blockchain security in the history of the United States. So we were basically looking to create a whole new framework to do this. Patrick Byrne, Jonathan Johnson, the attorneys that were involved, met with the SEC and FINRA and both the trading, capital markets, and enforcement divisions, because basically we were saying, hey, look, we're going to do something that's never been done before, and we don't want you to come back after the fact and tell us we did something wrong.
Yes.
So we had to be very, very smart in how we did this first offering. The company filed an S3 shelf, which actually usually shelves when you get filed, they go effective within a day or two. This one took 6 months. Back and forth with comments with the SEC to basically create a method to do a public offering of a digital security. And of course, we included rights on that S3. And when we eventually launched the transaction, we had to think in terms of foreign shareholders, domestic shareholders, people with IRAs, people with 401ks. And when they subscribed into the rights offering, how can the cash be delivered into DTC, into the escrow, and have the securities delivered back to where the cash came from? This is where the idea of stablecoins came from. So if you look at it, at that point in time, we had T+3 for settlement. So you send your cash in, you get your securities back. In order to send the securities back through DTC, it had to be a physical security because the T0 blockchain securities were not set up in DTC. But we wanted to do the first blockchain security. So we had to literally have a broker-dealer. I think at that time it was Dinosaur Financial. We had to have a clearing firm. I think at that time it was ETC, which is, I think, was Electronic Trading Company, which is now called Coinbase. We had to figure out a way to allow people to subscribe for the digital security. So we actually did an A and a B security. We did a digital and a physical preferred, what they called analog and digital, which I think was humorous because there was nothing analog about it. Then we had to we had to open brokerage accounts for people at Dinosaur to be able to subscribe for the offering. We had to have a third party do it because they had to do the AML, which is anti-money laundering, and KYC, which was know your client. So what was interesting is hundreds of people went and opened accounts at Dinosaur to be able to subscribe for the digital security. And anybody who subscribed to a foreign account or IRA subscribed for the physical that settled through DTC, which eventually actually traded on the OTCQB. Here's the problem. Let's say you're short the stock. We're doing an offering of a digital preferred share that's going to pay a 1% dividend.
Okay.
More than whatever the common pays. You now end up, you're short the common, right? You don't believe in overstock.com, whatever for reason you have. Maybe you don't like management. And now we do a digital offering with a physical offering of a security. And you don't know whose shares you're short, because when you short securities, you don't know who owns those securities ultimately. So you don't know whether you're going to end up buying the physical or the digital on the short side. So if you want to cover your short of the digital security and it doesn't settle through DTC, you have to go and open a brokerage account at Dinosaur Financial in order to cover your short. So we were able to identify a significant amount of the short sellers at overstock.com because people had to go and open an account at Dinosaur and disclose that they were short the stock in order to cover it, because it was the only digital security issued in the history of the world. So after we closed the transaction, we announced the transaction, I think it was around $15+ a share. After we closed, Overstock stock over the next 6 to 9 months ran up to over $80 a share. And we attribute a lot of that to short covering, because this was not a convertible preferred share. It was a voting digital preferred and a voting physical preferred. And you couldn't close out your short. You couldn't close out your short against the common with the shares issued in the offering, because there was no ability to exchange the preferred for common. So you fast forward to where we are today, 9 years later, and we have an administration that I believe is a little bit more crypto friendly. I think this is a good setup now to see where the future is. Now, what's interesting is since that original transaction, T0, I believe about half of T0 has been purchased by ICE, which is one of the largest exchanges in the world. ICE owns the New York Stock Exchange. So it's going to be interesting to see what develops. I do know that on T0, there was a successful St. Regis hotel that trades on T0 as a publicly traded security on T0. T0 is now an ATS, and I believe T0 now is set up with DTC. So now, if we did do a digital public offering of a security and it went through the T0 platform, it could in fact settle into your brokerage account as long as they're set up with DTC, which is a complete game changer from 9 years ago.
Wow.
It most certainly is, because I do remember through my DTC eligibility work that at one point DTC was like, we're not going to ever do digital tokens, and they certainly appear to have changed course on that. And I
think 9 years ago, I think the goal of T0 was to disintermediate DTC and capture a lower fee, because DTC makes a lot of money, and do it in a transparent manner. And I think over time, T0 realized that the vast distribution of DTC globally is so massive, it was better to partner with them than to try to disintermediate them. When we did that very first transaction for overstock.com, in order to monitor the change of ownership, I know that the company brought in Computershare at the time and Georgeson to be the transfer agent. But I believe now, someone like yourself can be the transfer agent on transactions like this. And in fact, I think the smaller like if it's an American transaction, a firm like yours might give better service than a Computershare. Computershare tends to be very strong on global transactions because they operate in so many countries. But most smaller issuers can't afford to work with someone like a Computershare.
Well, the other problem that a lot of smaller issuers run into is the really super big transfer agents like Computershare and Equinity are kind of bureaucratic. And so you get a lot of lower level employees that are kind of customer service reps, but they just don't have broad-based industry knowledge. So when you need when you need an advisor, and it doesn't matter if it's my firm or some of the others out there. The personnel at these transfer agents have got some really good experience that they can for small microcap companies, they can be valuable advisors to you on how to get things done. And that's one of the things that often gets overlooked, particularly when you're an over-the-counter company and you're going through the corporate action process with FINRA. If you're even a smaller firm like mine, in the 13 years since I acquired Mountain Share Transfer, I've probably worked on 100 to 125 corporate actions with FINRA. I mean, directly interacting with FINRA. So an understanding of the process is key. One of the things I want to ask you, Rich, do you have to be exchange listed to do a rights offering, or can you do it if you're an over-the-counter company?
You certainly can do a rights offering if you're over the counter. So the majority of rights offerings in the U.S. have been by nationally listed companies, but you certainly can do them over the counter. In fact, in the Jobs Act, in the original Jobs Act, they created a protocol or goal of amending Reg A, creating a new series for crowdfunding, and this new concept of 506C. 506C and crowdfunding aren't really a great strategy to raise money for rights offerings because 506C is limited to accredited investors only. Many people who have shareholders, their investors are not accredited, or majority are not accredited. With crowdfunding is only available to private companies. So neither of those work. But Reg A, which is interesting, allows you to offer securities in all 50 states as well as Washington, D.C., Guam, U.S. Virgin Islands, and Puerto Rico without needing to blue sky the securities in those states. So if you're a New York Stock Exchange or NASDAQ company, you're what's called NISME eligible, which I believe was passed under the Clinton administration, which basically says that if you're on a national exchange, which right now is New York Stock Exchange and NASDAQ, you can offer securities in all of those states and jurisdictions without needing to blue sky in those states. So prior to Reg A, if you wanted to offer securities, you would have to blue sky in all those states. So if someone files an S1 right now, you still have to blue sky in all the states where you're offering the securities. But if you file what's called a 1A under Regulation A, which some people call Reg A+, and if you're fully audited, you can raise now up to $75 million through a rights offering without having to blue sky. So that is a real game changer. We don't see a lot of companies taking advantage of it, but it's an obvious course. There's a blue sky memo that goes into it. I think there's still a notification to the states, but there isn't a review process by the states.
Yeah, that's significant. As you're probably well aware, NASDAQ and the American Stock Exchange, NYSE Venture, are in the process of updating a lot of their listing standards as a result of some of the poor quality IPOs that got completed last year. I have one of my companies that I'm serving as a interim president on that's currently going through that process. For regulatory reasons, I'm not going to give the name, but what we're looking at is that these changes are going to make it more difficult for smaller companies to raise capital. And I think that the rights offerings and the Reg A is going to be an integral part of that. And that's one of the things we're trying to communicate to investors.
What's interesting is if you want to raise a lot of money as an over-the-counter company, there's a very big problem with depositing those securities. Okay, so if you want to go and do a private placement, a Reg D offering, and then you want to deposit those securities, a lot of broker-dealers will not accept low-price over-the-counter securities. But in a rights offering, the rights are sent out as a dividend. And so it goes through the reorg department, not through the typical clearance of security process. And when you subscribe, the shares get sent back through DTC the same way that you subscribe. So it's even easier to deposit the securities through a rights offering than through any other type of an offering too. So it really does check all the boxes. it's interesting to me that so few companies are aware of this. I hope that this podcast is something that you share with many of the companies that you work with, because ultimately there has to be some education. And I don't believe that there's enough education out there as to why doing a Reg A rights offering is the way to go. But I do believe there have been some precedent transactions. There were a few banks that have done them over the last year or two. But I believe that the market is probably ripe to see a lot more of this happen.
Yeah, I believe that we're going to see more rights offerings happen, and I'd like to invite you to write a blog post about this topic at some point for the future. So what is next for you guys at Moody Capital? Where are you going from here? You're out building the firm and adding clients?
Yeah, so we're focused right now on working with high quality companies. We really want to stick with our companies. We're not looking to jump from company to company. But when we are banking a company, we want them to have a good experience. We want their shareholders to have a good experience, and we want to continue to bank them. So we're working on capital raising. We're working on mergers and acquisitions. One of our top consumer bankers just moved to Australia, and she is active in working on expanding her public practice as well as private practice. We do work with both public and private companies. On the private side, capital is much harder to raise just because it's more difficult. The regulations are tougher. Crowdfunding is an option for usually companies that have a big affinity group, but if you don't have an affinity group, it's very difficult to raise money. There have not been a lot of IPO exits for major VCs. There have been some rumors of some larger IPOs coming soon, but given the big fall in the Dow Jones, we aren't seeing the big IPO recovery that many had hoped for. We do believe that public companies are a great target for investment in private companies. We've been successful there. It seems that the biggest growth in venture capital right now is publicly traded companies with a VC arm.
Okay, that makes sense.
So for example, NVIDIA Ventures, Intel Ventures, Microsoft Ventures. I don't believe 3 years ago there was NVIDIA Ventures, but now there is. So you are seeing a lot of growth there. And what's interesting about those venture capital firms is they tend to be more long-term focused. Like for example, NVIDIA Ventures isn't so worried about an exit because they are an exit, right? They're already publicly traded. And if you are very, very successful and they own the majority of your company, at a later date, they could just spin you out and you could become a publicly traded company without them having to even do an IPO.
Okay.
So
a lot of options available. A lot of options on that.
Correct. So I think our focus is finding those undervalued companies that have great management that will continue to execute their business regardless of market conditions.
And if somebody's out there listening and they're like, I think my company is a good candidate for this, how do they get a hold of you, Rich? They got to track you down at a conference, or is there an easier way to do it?
Yeah, we like to use the internet. We like to use the phone. Happy to share our email address or phone number with your viewers if you believe that would be helpful.
Yeah, why not?
Our email address is info@moodycapital.com, info@moodycapital.com. My phone number I will hold for a later date, but info@moodycapital.com is the best way to get a hold of us.
Yep. And for all our viewers, I mean, I think Rich has brought up a lot of very interesting and insightful things. I think his focus on existing shareholders is extremely important, and one that the management of every public company needs to pay attention to what Rich has talked about today.
Yeah. Ultimately, remember, guys, your shareholders are your customers. You got to treat them like a customer.
And that's one of the best ways I can ever think of putting that. I may quote Rich again for a while on that, and then, but also, I mean, here's the thing: is as Rich talks about, when you are doing your financial plan and your financial model, or when you're running your business, the time to prepare for a capital raise is before you need it. You want to raise capital while your stock is doing well. You want to do it in a method that's not done at a discount that rewards your existing shareholders. And this is what Rich is doing. If you wait until your stock starts to drop, the options in the window of opportunity start to close on you. So having a smart advisor who says, 12 months, 18 months out, you're gonna be drawing down the capital and need more. Let's get started now. That's a smart person you want on your team, and that's somebody that's good to work with. Is there anything else you'd like to add, Rich, or any other further comments?
Yeah, I guess what I would like to say also is, when you're choosing a transfer agent, it's great to have access to the CEO and the man in charge. You mentioned Equinity. We've had a great experience with Equinity and ComputerShare and all these other transfer agents. But being able to get the CEO on the phone, of the transfer agent and have a discussion with them and have them understand our business and recommend strategies, not just domestically, but also globally. I know, Eric, you and I have talked about listings on foreign exchanges,
Yep.
Sweden, Norway, Denmark, Ukraine, which now is really not an active market, obviously, for obvious reasons. But we have companies interested right now in listing in Hong Kong, Australia, and those are all vibrant markets. And I think the cross-listing opportunity is also large, and having a good transfer agent to work with where they're willing to go the extra mile and figure out how to do some cross-border things and some newer strategies that others aren't thinking of, some outside of the box strategies, I think is important also. So Eric, I appreciate you and everything you've done with us.
Yep, I appreciate the positive comments. For those who are interested, I'm the president of Mountain Share Transfer. Our web address is mountainsharetransfer.com. If you'd like to speak to myself or one of my staff, the phone number, which is also on our website, is area code 404-474-3110. We do our absolute best to try and answer every single phone call that comes in. We can't answer them all, but we do try, and we do respond to emails. And the general email that is read by everybody in this firm is service@mountainsharetransfer.com. And the reason we picked service is because we believe that the transfer agency is ultimately a customer service business. It is our job and our responsibility to give our clients and their shareholders the absolute best service we can. After all, they have entrusted the corporations they have invested their hard-earned money into. They have entrusted the management of those companies with their money. And we recognize the responsibility that creates when we interact with those shareholders. That it is our job to recognize how, what it takes to invest in a company and how much that means to people. So thank you very much on the positive comments there. As far as upcoming conferences, in approximately a month, I will be in Las Vegas at the Planet Microcap Showcase. It is at the Paris Hotel this year. It's going to be its largest ever. I will be doing a podcast, I believe, live from there Tuesday morning. And Karen will be my co-host, and we'll see if we can get a couple people to participate with us. Am I going to see any of the other events? Are you going to be at NEBA this year or anything like that?
You'll probably see us floating around a few of these conferences, for sure.
That is good. Karen, any closing remarks?
No, I think it was a great show. Obviously, we tend to run out of time, don't get all the questions answered, but all the information that Richard provided was really enlightening. And it was great to see, you guys banter back and forth because you're both such experts with deep knowledge about the space. So perhaps we'll end up having, or you and I can cover some of those questions in the future if Rich is unable to join us again. But hopefully you'll be on again sometime.
We'll definitely plan on having Rich back. I'd like to thank all our viewers and listeners for joining us. Look for us up on Spotify and YouTube as well as LinkedIn. And everyone have a nice day. Goodbye.